You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. And now, it's time for the show that breaks down the options market from unusual activity alerts to market analysis, strategy overviews, listener questions, and much more. If it involves puts and calls, then our all-star panel will break it down. It's time to hit the Option Block with your host, Mark Longo from the Options Insider Media Group, and co-hosts Uncle Mike TOSAW from St. Charles Wealth Management, along with Mark the Greasy Meatball Sebastian and Andrew the Rock Lobster GIOVINAZZI from OptionPit.com. And now, get ready to hit the Option Block.
All right, everybody. That music means it is time once again for the old OB, a.k.a. the Option Block, a.k.a. your bi-weekly source for all things options related. My name is Mark Longo from the OptionsInsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. Reminding you, if you like what you hear, this show, anything else here on the network, keep those reviews, keep those comments coming. It really does help new folks continue to discover the network and the programming en masse. Also, keep those questions and comments coming. We do love to hear from you guys. Let's see who we're hearing from on the old program today. First, let's go back out to the dark and stormy shores of Maine, where we go on up the cliff to the GIOVINAZZI palatial fortress, where we are joined once again by the Rock Lobster himself, Mr. Andrew GIOVINAZZI from OptionPit.com, by way of Carmen Lion Capital, by way of, what's it called now, Robinhood Trader? I can't keep track of the branding over there, sir.
Well, you know, the Little John was successful, but it was only a 90-day product. And Mark just about, I think he doubled his money. So I thought that was a pretty good feat. So now it's called Robinhood. And as long as there is some flow, we will be Robin Hooding. So all good things happening at the Fortress and in Option Pit.
So you're going to change the name of the thing from Option Pit to RobinhoodTrader.com? Is that the new name?
No. We got all kinds of stuff coming down the pipeline. It's going to be a cornucopia of like hedge long SPY and all kinds of goodies about how to trade these here option products. So look for more and interesting option products coming from Option Pit soon.
All right. We shall keep an eye out for those. And we'll also keep an eye out to all things realized volatility, because I'm pleased to say we are joined once again by the dynamic duo of Mr. Don Schlesinger, the president, and Mr. Bob KRAUSE, the chairman and CEO over there at Demand Derivatives. Bob and Don, welcome back to the Option Block Show. Gentlemen.
Hey, good afternoon, everybody. This is Bob.
Thanks again, Mark. Always good to be here.
All right, and last but certainly not least, we go back out to the tranquil highlands outside of Chicago, even though highlands aren't really that high out here. Let's just call them the flatlands. Out to St. Charles once again, where we are joined by Uncle Mike TOSAW from St. Charles Wealth Management, who's busy counting up all his dollars from the big short in silver. Mr. Uncle Mike, welcome back to the program, sir.
All is well. And, we kind of figured that silver wasn't going to be a repeat. Sorry, my tongue's twisted. Be a repeat of GME, but nonetheless, silver. Every day is fun with silver. Every day is fun.
I guess you missed that overnight print of it hit 48 there. That was a good one for everybody. I guess you missed that one, but we'll keep on rolling. I'm joking, of course, listeners. Before he gets angry and runs off the show to try to see what he missed as we head right on into the trading block.
It's time to break down the latest topics, trades, and trends in the world of options. It's time for the trading block.
All right, everybody. Welcome to the trading block, the portion of the show we break down what the heck is trading, and it's yet another day that ends in Y, which means there's probably going to be green on the screen, and that is the case yet again. Most of the major indices up about 0.75%. Dow up a little bit more, but that's pretty much the ballpark range that they're all in right now. We're also seeing, after some rallies over the last few sessions, we've seen vol take, I think, to put it mildly, a bit of a break. We got VIX come into showtimes right around the 22.5 level. That puts it down about 7.5 points from our last show and well off the highs, about 10, almost exactly 10 points off the highs that it hit not too long ago of 32.68. VVIX down from its lofty heights north of 130, now down to about 108. Puts it down about 24, almost 25 points from where it was this time last show. VXX, the product you guys all love to fade. Well, hopefully you were fading it this week because it faded pretty hard. It's about 16.75 coming into the start of the show. That puts it down about 3.5 points from last show and well below the north of 20 level it hit not too long ago. And VolQ, a.k.a. the at-the-money vol of the NASDAQ there. It's about 22.75 when we kicked off the show. That puts it down almost 6 handles exactly from where it was this time last show. So the moral of the story is pretty much down across the board when it comes to vol, up across the board when it comes to the major indices, and kind of meh for a lot of these names that everyone was looking at to be the next big short squeezes out there. They took a big hit this week, GameStop and AMC and others. They got some of it back, but nowhere near the levels they were at. And, of course, the much-anticipated, much-ballyhooed silver short squeeze never really materialized. We saw a brief pop there in silver and related products like SLV, and then they kind of gave it up pretty quickly, and that was pretty much it. And right now, come into showtime, they still really haven't gotten much of that move that folks were looking for, folks were hyped about, folks were really excited about. We kind of mentioned that on the show this week. Silver, a different beast than a GameStop. It's kind of hard to make lightning strike twice, and that certainly did not happen out there in silver. So a lot to unpack. Let's go around the horn the opposite of the way we came. Let's start in the land of our perennial silver bull, a.k.a. Uncle Mike. Sir, on this Uncle Mike type of day outside of silver, what is lighting up your tape, sir?
Well, it's interesting to watch. We're getting closer to the all-time highs that the market that the S&P 500 put in a couple weeks ago again. It's definitely, to say that the market's been volatile lately would be an understatement, quite frankly, on the fact that something like GameStop can kind of put a monkey wrench in the entire market like it has. It's really a unique time, to say the least. So a lot going on along those lines. It was interesting. When Friday's statements came out for my clients, volatility numbers were they're really out of whack in a lot of ways compared to where a lot of volatility is. And so I really didn't have much of a need to change too many of my positions, and so I didn't do anything. And so on Monday, market snaps back, and then all of a sudden we're in a position to where volatility is down or back in the low 20s anyway, at least with the VIX. And so I had to contact a bunch of my clients saying, hey, this was kind of an anomaly, and everything's better right now. So just look at your statement, but also look at your balance today. So it's been unique from that standpoint. Of course, we've had the Google earnings last week, and a lot going on, to say the least. I think that with silver, like I said on the show on Monday, you're not going to mess with silver. People, they may have messed with Wall Street, but when it comes to margin calls, you're not going to mess with LaSalle Street, and that is the Chicago traders. They know how to handle such things. So a lot happening, but I think that the thing to watch right now is, can we break through and make a new all-time high? We're really close to it right now.
There you go. Uncle Mike on the move there as we keep on rolling here with the trading block in more ways than one. He's a guy who's always on the move in some capacity. Let's go back out now to the demand derivatives dynamic duo. Gentlemen, what's been lighting up your tape out there in the world of demand derivatives and the world of realized volatility?
We've been discussing silver too, and yeah, it's pretty interesting. Don?
Just a really quick observation about realized volatility and what we've seen in since the last time we were on the show. If my memory serves me correctly, I talked a little bit about that spread between VIX and actual volatility, which some people refer to as the risk premium. And historically, it's usually 3 or 4 points over. And I think I pointed out at the time, I think that VIX was at 24 and realized volatility was at 10. And we had this huge spread of 14 points, which I said was somewhat of an anomaly, but that was persisting for a while. Well, Mark, you mentioned, on the last show, you saw VIX at 32. And at the same time, I just took a quick look, realized volatility was on the way up to 14. But if anything, the spread widened to 32 minus 14, which was 18. So if you were able to do such a spread, and if we had our realized volatilities futures trading, you'd have had a little bit of pain. But the good news is that as we sit here today, we now see VIX in the 22 handle. I'm looking at 22.3, and realized volatility has climbed all the way to 16.6. It was actually 17.3 yesterday. So all of a sudden, that spread that I said, sooner or later just really has to collapse, is now 22.3 minus 16.6, or 5.7. So there you have a much more normal relationship between implied volatility and realized volatility. Final comment, realized volatility was 17.3 yesterday, and that was the highest level that we had seen since December the 2nd in about 2 months. And of course, we attribute that a lot to what happened with GameStop and all that went on for the last couple of weeks. But that's the scenario between VIX and realized volatility and what's been going on for a couple of weeks.
Something happened with GameStop. I must have missed that, Don.
Yeah.
I've been busy.
And in our weekly realized volatility ranking sheet, you would kind of expect silver to be up there because it's been moving so much. And it's now the highest one out of the 40 assets that we show. It's in the 91st percentile. So 91% of the time, volatility has been lower in silver. And that's pretty interesting. And gold, it kind of moves with silver, right? But not exactly. It's in the 76th percentile right now. Everything that's really low are generally interest rate products, like the 2, 5, 10-year notes and those kinds of things. So it's pretty interesting to see.
Yeah, so the silver squeeze didn't amount to the price movement everyone wanted, but it did juice up the volatility, obviously, and we're still seeing some of that. And obviously, moving up and then moving back down again, that's vol at the end of the day, and we're seeing that reflected in the realized volatility rankings. Thank you for that. Let's go back out now to the dark and stormy night, always on the shores of Maine. Never the sun shall be seen out there. Once again, we visit the GIOVINAZZI palatial compound on the shores there. I'm sure Vol Man has been busy. There's been a lot of vol coming and going, mostly going this week. Mr. Rock Lobster, what has been coming across Vol Man's radar, sir?
Well, I love having Don on here because he always has the on point realized vol, and I want his darn realized vol futures to start trading. So I think it will be a gangbuster and quite interesting product, to be honest. But I digress. A vol point of view is very interesting. So here's where we are. We are about to dip into the 21 handle, which is the line of death in the COVID era, what I'll call. So how I trade vol is I trade vol by event. As far as I'm concerned, we're still in the COVID event era, meaning the reason for the vol event was this COVID yucky thing that's wrecking everybody's life, screwing up schools, and, I guess we don't have to write that story. I'll know what it is. But that basically caused the vol spike and all the massive dislocations from it. And as far as I can tell, it's not over. I don't think it's as dire as it was. But I remember a joke from Eddie Murphy about like luggage, you can't get rid of it. And it seems a little bit like that. So we do have the vaccines, and now more people have had it. So that means, they probably won't get it. But anyway, so there's still a lot of uncertainty around it. However, what I do is I take all that uncertainty and it gets boiled down into a VIX number. So is VIX an exact science as far as how accurate it is or this or that? To me, I look at it a lot of ways. I always look at it in relative terms to different things, like how the curve is pricing, how forward vol is pricing, how our short-term realized is pricing. There's lots of ways to trade VIX based on, different stuff. Everybody has their own way to look at it. But right now, what I find is we are back to this level that we have come to many, many times since COVID started. VIX is about down to 21. It's about to trade the 21 handle now. You could buy all the 21 puts you want in VIX for 20 cents right now. I bought a lot of them for a dime. And of course, I jump off the same cliff every single cycle, thinking maybe one of these days, we'll actually break to a lower vol. So what I won't do anymore is I won't have a massively aggressive short vol position here. So, but Don is right. Realized vol is still in the teens, right? If we didn't have that crazy 2-day move, it would probably it'd be in the 12 handle or 11 handle or something like that.
And it's probably on the way down again.
I agree. I agree with you. So as we get here, it's like, what will keep vol down? And I think this GameStop was a perfect example, and the spike in VIX last week was a perfect example. I think overall the liquidity provider community is just short a lot of contracts. And if I was a market maker, Mark, you were a market maker, Don's had his, we've all had our face ripped off by vol here or there. And the reality is, if liquidity providers are buying contracts, VIX isn't trading at a 22, it's trading at a 14. So there is still a lot of everybody but the liquidity provider community buying contracts. I think they're just buying stock and keeping the puts that they own as protection, or a lot of speculation buying upside calls. I think GME was we'll just call it the peak of the frenzy. And it doesn't mean it can't happen again. But what happens is just people continually buy stuff. The vol just explodes and explodes and explodes. And the liquidity providers aren't taking it down until there's some vol sellers. So I think that's been happening in the broader market for a while, ever since November. And it surprised me, the strength of the rally and the bounce, and I guess I would just say the relief rally, I guess, that the U.S. didn't have a civil war or something, or what anybody else was thinking. After the inauguration, same thing, more relief rally, and Congress keeps trying to throw $1 jillion at everything. So, there's certainly not a reckoning in the bond market yet, or at least has the Fed is able to do what they do. And it just leads, to higher equity prices. Nobody's selling their puts and people aren't selling their stock. So when I think of that synthetically, the public funds, everybody else, they're long straddles and they're watching things go up, liquidity providers short straddles. So until some people actually start selling puts again, selling the 3,000, selling the 3,200, selling the 2,500s in SPX, and start just crushing that stuff and those premiums, I think vol is going to stay where it is. Now, can this all change tomorrow because everybody decides it's cool? It's totally possible. you've got every time we think a stimulus package is big, just wait another 10 years and it's 2 or 3 times the size of the last one. So anyway, so we have VIX at 22. It will probably trade on the 21 handle today or tomorrow. And again, I think if you see some people starting to write calls again, start throwing some paper back into the market, the ball will come down relatively fast. I don't think it's happened yet in mass. So that's why I think when you look at where puts are in the vol products, there's also some serious handicapping there. For vol still relatively high in VIX or in SPX. So you've got the 24, 25 handles where those futures are covering 27 in March, almost 27. So it's a pretty big premium, right? So that stuff has not come in yet. There's not that hard seller of it. And that is putting a floor under VIX cash. Can't go any lower if nobody wants to sell the juice. So, that's why you see these like this 21 put. So people are looking at VIX 22. They're seeing 21 strike and the puts are 20 cents. Now, I think risk reward wise, they'd make a good play. Of course, I'm talking my own book, but that's where we find ourselves. I think that's one of Don's complaints about the product. It's like freaking VIX is 22, the 21 puts but the future's 25. So we're trying to get some kind of alignment here on where things are priced. But ultimately, the products have their quirks because of volatility, and that's what we got. So I'll leave it open because I invoked the Don so many times here. He's got to be able to chime in.
Anything to add there, Mr. Schlesinger?
No, I'm going to leave it at that. Thank you.
All right, we'll keep on rolling here then. There's a lot popping off here in the markets, as you might imagine, listeners. Let's start with the most active indices, the big indexes you folks like to sling around. Let's start with VIX land. We were just talking about VIX. VIX actually doing some paper yet again, 408,000 contracts on the tape as of a few minutes ago. And the ADV is ticking up as well, up to about 658,000. It wasn't too long ago. It was threatening to break 300,000. In the other direction from an ADV perspective. So things have certainly turned around, and not surprising as we've seen vol swinging around, even though it stubbornly refuses to break that 21 handle just to mock the rock lobster. SPY at about 1.75 million contracts, the ADV about 4.3 million. The S closing in on 500,000 contracts, the ADV about 1.25 million out there. So the S ticking up a little bit of late as well. The Qs, 456,000. The ADV is just a tick north of 1 million, so not quite half a day's worth of volume on the tape yet for the Qs. IWM, 404,000. The ADV, 745. The small caps have been where kind of everyone's attention has been glued of late. In particular, those very far out of the money calls out there. Looks like some decent paper, but light paper out there overall today compared to recent days. In terms of the single names, which you folks are trading it up. This list has been fun to watch because it's just jumping around all over the place these days. Whatever the hot shorted name is now hitting our top 10. It costs you 257,000 contracts to break into our top 10 most active today. That gets you to PayPal. Number 9, Sundial, 275,000. I love this one. This is a name that was 50 cents a few days ago. It's now $1.20. So it had a good run, but it's still a $1 name, and a 50-cent name a few days ago. Yet there's almost 300,000 options contracts trading on this thing. A good thing the Viceroy, Mr. Alex Jacobson, is not on with us today because he would be deeply offended by such options activity. If the name's below $10, he doesn't like any options slinging over there. NEO, number 8. 294,000. Number 7, Qualcomm, 325,000 contracts on the tape. Number 6, the formerly sleepy Ford, lighting it up today to the tune of 428,000. Ford does have earnings after the bell. They're trading about almost 11.40, up about 17 cents right now. And they've had some movement of late out there, seeing the partnership with Google and everything else, and it's translated to perhaps a little bit more interesting, a little bit more dynamic stock than the sleepy name that struggled to make it past 9 for the better part of a decade. Then we got Nokia, number 5. They've been popping into our top 10 a lot of late these days. 489,000 contracts on the tape for them. Number 4, AMC. Yeah, they're still up there. 491,000. The short squeeze out there seems like it has not quite run its course, but it gave up a lot of the ghosts. It got up to 20 and I believe beyond out there. Let's look see how high it got. 1990, so close to 20. And then right now, 7.25, giving up nearly $2 today as well. So that one had some interesting run to it, but looks like a lot of the bloom is off the rose out there. Number 3, Tesla, all the way down at number 3. Tesla, 495,000. What could possibly usurp Tesla for the number 2 spot? Yep, it's GameStop. 575,000 contracts on the tape. Let's see where our friend GameStop is hovering at. Oh, well shy of the 100 handle right now. A little bit shy of $60 off 32, almost $33 today. Off another 35.5%. So pretty much right at the level it needs to be for, we were talking about it about a week ago. The vol was about 340%. It got higher, it got up to about 1,000%. But at that time, if you bought the par puts, they were pricing them around 30-odd bucks. So actually, you'd be making money now. But that's how much of a move you needed, listeners, for those absurd vol levels if you wanted to pay them to actually happen, to make money on that trade. You had to have the absurd annihilation that we saw out there. And we did get it, so you didn't make money, but you were paying through the nose for that privilege. Number 1, of course, Apple, 886,000 contracts on the tape. Let's head on out there. We're talking about earnings this week. There were quite a few big names popping off. Monday, we had, well, let's just go to Tuesday. Tuesday was a bigger day. Amazon, Alphabet, Pfizer, EA, Alibaba, ExxonMobil, Chipotle. Wednesday, we had Spotify, PayPal, Qualcomm, and eBay, and Grubhub. Thursday, we have Merck and Peloton and Snap today, Activision, Blizzard, WWE after the bell. And Uncle Mike is excited about that one. We got some earnings move results hot off the presses from this morning for the recent action. You'll have to go to our site and check it out for the recent ones as well, for Google and Alphabet and all that fun stuff, and Amazon. Let's see, Qualcomm we have here. They popped off yesterday. They were pricing in, let's see, they were closed at 162.30. They were pricing in about 5.8%. They delivered about 10%. So a little bit of outperformance from a vol perspective. That's interesting and nice to see. eBay, they were at $58, pretty much even going into their announcement. They were pricing in 6.6%. They delivered 5.3% up. So we're going back in the other direction, which is kind of what you'd expect given everything else we've seen over the past year. Grubhub, they were on the third as well, 74.79. They were pricing in a whopping 10.3%. They delivered 3.7%. So seems like we have a bit of a trend here, listeners. And we had Yum Brands before the bell today as well. We have that one hot off the presses. They were priced, let's see, they went into their announcement 104.73. They were pricing in 3.5%. They delivered a whopping 0.6%. So it seems like the trend that has persisted throughout most of 2020, which is don't buy vol around earnings, is persisting through 2021 so far, as most of these names, from a vol perspective, are getting annihilated. The earnings season report is backing that up. Listeners, first week was 53%. So you've got effectively 53 cents on your dollar when you're buying vol out there from an earnings perspective. Week 2 so far, shaping up pretty much the same, 56%. So far, it's another blood red season out there for the vol buyers when it comes to earnings volatility. We do have some big names still popping off, though. I said we have Ford after the bell today. Let's look at them really quickly because everyone and their mother seems to be trading Ford. They were at $11.20 as of this report. They were pricing in 83 cents. In the past, they've moved 59 cents. And then we got Activision after the bell. They were at $93. They were pricing in about $4. In the past, they've moved about $4. So not much change there as well. We've got Peloton after the bell today as well, 147 and change. Look at that, how much that name has changed over the past year. They were pricing in $12.82. In the past, they moved $11.80. So an extra buck worth of juice. Is that smart in the current climate? Probably not. I guess we'll find out. Snap, 59 1/4. They were pricing in about $8. In the past, they moved 11.12. So they're getting it. They're pricing in less vol. WWE after the bell. Let's see how much vol is going on in WWE, by the way, $56.50. They've rallied quite a bit over the past couple of months. They were trading in the 40s and high 30s, I believe, not too long ago. Let's see. Oh, look at this. They were pricing in $3.82. In the past, they've delivered exactly $3.82 worth of volatility. So it looks like someone got the memo out there in WWE. There's a ton more of these. You guys can find these for yourselves. You know where to go. TheOptionsInsider.com. Click on the Options News and Articles tab, top right corner. Check out all those reports, courtesy of our friends over there in Oras Land. Now it's time for us to unleash the Eye of Sauron. It is time for the Odd Block.
It's time to break down the most interesting, unusual, and downright questionable options activity that's been identified by theoptionsinsider.com. It's time for the Odd Block.
All right, everybody. Welcome to the Odd Block. Time to get weird, time to get wild, time to unleash the Eye of Sauron. We're going to unleash it once today, Mr. Rock Lobster. Then we're going to jump into the Wayback Machine because we still have a huge back catalog of trades to analyze and see how they worked out. And our audience, I know you do as well, Mr. Rock Lobster, they want to see how these folks are doing. So we're going to do that for them today. But first, let's see what our Eye of Sauron found for us today. Actually, not a lot of huge, weird, crazy trades lighting it up out there today, despite the fact that there's some volume on the tape. I guess if you count outside of the, let's say, hundreds of thousands of contracts trading on a $1 name, outside of that weirdness, not much else. Let's see, our Eye of Sauron found today Blackstone Mortgage Trust. This is the newcomer to the Odd Block. Ticker symbol BXMT, trading right now $27.86, up about 60 cents or about 2.25%. This is one that's had an interesting year. A year ago it was trading almost $40, $38.70. It got up to about 40.25 right before all this madness, February 21st, which is hard to believe we're coming up on almost a year to that anniversary of the worm really turning out there on February 20th of last year. And this name took a beating in that time frame, sold off to $12.67 about a few weeks later. Then it started rebounding by June 8th, which is the day we like to watch here, which most of the market seemed like it peaked there, at least for outside of the FANG names. This one peaked at $29.25. Then it kind of never looked back. It kind of sold off down to about $21, $22 and bounced around there for the better part of the year until almost November. Then about early November 9th and 10th is when it started trending up, got up to $26.05 again, so still south of that level it hit on June 8th. It didn't really surpass that level again. Actually, looks like it got close to it, but it never did. It got hit 28 and change in December, so it stayed below that June 8th high the rest of the year, and it still is there right now, $27.89. That's kind of where we find ourselves right now. So it ticked up a little bit in November and December, but not quite back to those levels. Let's see what our Eye of Sauron found out here. It looks like, I was kind of feeling call paper out here, Mr. Rock Lobster, and that appears to be the case. It's 3,332 of the July, going out to July. It's our first July paper on the Odd Block this year. The July 30s going up for $1.25. This market was pretty wide, as you might expect. This name doesn't do a lot of paper. This market was $1 at $1.95. These went up 3,332 times for $1.25 on the Philly. There are earnings in this, as you might imagine, between now and July. There are earnings. The next announcement is actually pretty soon. It's on February 10th. So coming up next week here, they have an announcement. So looks like Mr. Rock Lobster has the feels of someone perhaps deciding, looking at that chart we just looked at and said, you know, this name has really never managed to break past its June 8th high again, which was shy of $30. So I'm pretty safe selling the 30 handle for $1.25. And if it gets up to 31.25, I don't mind letting some of this stock go. Is that your feeling as well, sir?
I was of the mind on this one. Were you feeling a little buy ready on this one?
I was, yes.
Yeah, I'm same thing here. A weird, like a mortgage. I don't even know as mortgage trust. I assume it's like Annalee like all those weird, funky, which I never quite understood exactly what those companies do. By the way, those mortgage companies that buy mortgages and pay a huge dividend. I think so. Again, trading these stocks like way back when a lot of people that were trading GME weren't even born yet. Actually, that's how I'm just dating myself now. It is looking like a buy right, and I think that is a stock and trade of a lot of these sort of high yielding products. They just sell a little option juice against them, jacks up the yield a little bit, and they make money. The only problems you have with these, I think, mortgage trusts, when rates go up, they tend to tank a little bit. So that's what I would see on this one. So I'm just assuming a little yield play there.
All right, little yield play. Let's go out now to not a small play, but a large play. Let's dial our Wayback Machine all the way back, not that long actually, Mr. Rock Lobster, just a few weeks ago, to January 21st. You remember we talked about your favorite name back when Mr. Grigas was on the show, back when OX was on the show, before it was a dominion of the Schwab empire out there. He used to talk up ZNGA all the time. I believe at the time he was very excited about the 5-strike calls. That's a little bit different regime right now. ZNGA right now trading $10.33. So a little bit north of that. At the time he profiled back on January 21st, as you remember, Mr. Rock Lobster, the February 5th, so going out tomorrow. These are the weeklies, so they're still live technically, but it ain't looking good for them. It was the Feb 11 calls. Someone had the mother of all axes to grind on this strike, and they came for it, and they came for it pretty hard and pretty sizably, listeners. As you recall, on the show, we profiled someone looks like gobbling up 14,445 for 38 cents, but then they didn't stop there. They picked up another almost 4,000 for 50 cents, and we saw more piling in after that to the tune of almost 45,000 going up on the day, and most of it was heading towards the offer side of the fence, including that early print came close to lifting the offer, and we saw the vol also trending up throughout the day on the latter prints, so that's always a clear indication that they're probably buying these bad boys. So it seems like, Mr. Rock Lobster, we had paper buying 45,000 contracts starting at 38 cents, going up to 50 cents, maybe even beyond. We don't have all the prints of how high they got, but let's just charitably assume they topped out at 50 cents. There were earnings. I should say there are earnings, but not in this cycle. They bought all these options. They didn't even get any earnings bang for their buck. So the stock had a little bit of a run, but not quite what it needed. Let's see. Let's go back here. We got it all the way back to January 21st. The stock was, as I said, right around 10.30 or so. And it did gap up quickly. The next session, it was trading $10.71. And that was about all the move this guy was going to get. So if he was going to get out of Dodge, he had to do it literally the very next day. And we all know how hard that is when you're put on a big position to take it off the next day. The stock actually got annihilated the next couple of sessions. It was trading $9.85, so almost $1 lower a couple of sessions after that. So these things got beat up pretty hard, and he never really got a chance to get out at any sort of appreciation level outside of that one session. So now their stock's still trading at 10.33. So I think you can kind of do the math, listeners, and figure out that these 11 strike calls going out tomorrow are now effectively worthless. They're trading for 1 cent out there. So on the activity that we just profiled, it looks like paper dropped around $800,000 just on those two trades. If you add up all the other paper that went up that day and assume it was all related from the same player, which it seems like it was, then you're talking about 1.5, north of that actually, close to 1.7 million on all week. Again, we don't have all the prices for the latter kind, so we're kind of guesstimating on that. But in that ballpark, 1.5 to 1.7 million. Mr. Rock Lobster, is that your takeaway as well? Someone threw away a whole bunch of money on a very aggressive, very near-term swing for the fences in ZNGA that it seemed like for a day they were on the right track. And then the market is a cruel mistress, sir. It took it all away.
It did. Well, sometimes the YOLO call buying doesn't work. Did you know that, Mr. Longo? That
I don't believe you're legally allowed to say that. If you do, all the Redditors will come for you.
So there goes my hate mail. Thankfully, I don't have too many Twitter followers, or I think I would have a lot more hate mail, possibly. So
we'll see what we can do to rectify that for you.
This is one time they got a day left. Hey, they got a day left, and the options are what I would say they're in touch. So it's possible. It's possible, but it looks like it might be a road too far to hoe at this point.
Yes, that is indeed a bridge too far to mix all of the metaphors out there. But hey, he's got a day. He's not going to take them off now for a penny. You're in this far. You've wasted all that money. You might as well see what the lottery ticket gods can bestow upon you. That sounds like that's what he's doing. So good luck getting $45,000 for a penny now anyway, selling them. All right, let's move on to our final name here. That's why we say when you get the move, listeners, sometimes you got to get while the getting is good, especially if you're trading in very near-dated contracts, especially if you're long premium, because that theta kicks in and it's nasty. And as we see here, it did not work out too well. All right, let's go out to our final name. This goes back to January 7th, so almost a month ago, Mr. Rothlops. I'm not going that far back. I don't want to test your memory too much here. I know if I go back like a year and a half, it's going to blow your mind. So let's go out here to January 7th. We reviewed some, look like pretty sizable call love here in NUVA, N-U-V-A. This is Nuvasive Inc. This is a medical device company. At the time, we profiled 9,852 of the Jan 65. So another Jan trade going up here for $1.25. These were 80 at 125. Seems like paper was buying these bad boys. That was a roughly, let's see, what was that? Almost 100 vol, 98.3 volatility. And it looks like so. Obviously, it needed a little bit of a run. The stock at the time was 58.58, so it was a pretty aggressive trade. They needed this thing to move by the end of the month, just a few weeks. It needed to move almost 7 handles, so you're talking a pretty aggressive move. They had earnings coming up, but not in the cycle on the 18th. So someone seemed like they were betting on a very, very near-term pop in this name. And like our other one, unfortunately, they did not receive it. We had a bit of a run not that long after this trade. Actually, the day before this trade, the stock was at 59 and change. And then it sold off on the 7th, and that's when they bought these calls. So even more interesting timing, a big sell-off for $3 or so, and yet they come in and decide to gobble up on some very near-term upside. They had a moment when it hit 58.5 again. That was probably about as close as they got in the lifespan of these options. The stock closed at about $57 on expiration. These calls were still open. There were a total of 11,500 open on expiration. So once again, Mr. Rock Lobster, we're 0 for 2 here. Looks like paper lost out on this one as well, dropping about $1.25 million. Those are 2 pretty big ouchies we got. Maybe showing the trend. All the line in the sand puts that we profiled made money pretty much for the last year, and everything else we profiled on the premium buying side, not so much, sir. Is that your takeaway as well?
I mean, it is. I mean, the reality, why do people like selling puts? I actually had a conversation with somebody this morning on this very issue. It's like, you sell puts in what you can afford, even though you might not want to take delivery because you're not buying them to take delivery necessarily, but you have to be able to afford to so you don't go broke. But buying calls, the hardest part is you got your shot. If you buy them, and you have to get out of them. And you have to be diligent. It's not easy, especially if you have like what I would say like a 60-day and under call. Like you got to be there when the market wants them because you know as well as anybody that window can be short indeed. So I think that's just why the line in the sand puts do better.
The window for the odd block is short as well, and it is closing. But before we close it, Mr. Don, I think you have some thoughts on some of these crazy odd names we were talking about here, sir.
Well, I just have some thoughts on a future show when you're going to gather the destruction and the path of GameStop calls, probably starting at 400 and going all the way down to 60 today, and try to take a look at how many of those calls expired worthless from those who thought they were going to make a quick killing.
I'm scared to do that, Don. That's going to be a very bleak story. I just did a show with the folks from the Securities Traders Association just earlier this week, and they were saying they think when all this wreckage is total, it's going to be much worse than even the flash crash, which got everyone in a tizzy, but that only lasted a very short period of time and didn't really impact that many people. This one, the wreckage could be, I think, as you point out, Don, much more substantial. Speaking of GameStop and all that stuff, you guys have thoughts. We have questions for you guys as well. So let's get to a little bit of the old mail block.
It's time to take your seat on the All-Star panel as we read your emails, tweets, Facebook messages, website comments, and much more. It's time for the Mail Block.
All right, everybody. Welcome to the Mail Block. You guys have been hitting us up hot and heavy with questions. We also have questions for you. We turn the spotlight on you, which is very interesting these days because there's a lot going on. We've had a lot of polls. You guys have been firing off your opinions. You're not shy to share your views with us, which we appreciate. Keep sharing those views with us. Our current poll right now, it gets along the lines of what Don was just talking about. We ask you guys, there have been many debacles that left lasting impacts on the options market. The 87 crash, long-term capital, the dot-com crash, the great financial crisis, and just to name a few. There have been many. Should we add the GameStop frenzy to that list? In other words, is this a really momentous market-shaking event that's going to have ramifications for a year to come? Gave you two choices, very simple. Yes, we're living in a post-GameStop world, or no, this is a tempest in a teapot. Easy for me to say. Let's go around the horn. Let's go back to the demand derivatives hot seat. Let's start with Bob. Bob, I'm curious, what are your thoughts on this? Is this going to have lasting ramifications, or is this a tempest in a teapot? Easy for me to say. I can't say it. Teapot. There we go. And then more importantly, what do you think our audience is voting for, sir?
Well, that's a really good one. I don't think it's going to have lasting effect on the options market. I think that the lasting effect is going to be on, the SEC and the rules and, Robinhood and their model and like that whole thing about, the social media aspect and all of that. I think that that's a real turning point for this social media phenomenon, if you want to call it that. But yeah, as far as the options market or lasting effect on the markets per se, I don't see that just having a real effect. It's kind of like the crude oil thing. We talk about it, we still reference it. That it went negative. About 9 months ago, something like that. But it didn't have a lasting effect other than those few days that it occurred.
Interesting. Good points. And Mr. Don, same question for you. Do you agree with Bob? Do you disagree? And also, what do you think our audience is voting for, sir?
I agree with him. I think if your audience is composed of sophisticated traders and experienced options people, that they're probably going to vote for tempest in a teapot also, and that would be my point of view. I also think that you're going to have upcoming congressional investigations into all of this, and it wouldn't surprise me if some kind of legislation comes out that could have a dampening effect on the whole thing. And finally, of course, you had Mike at the top of the show point out that the attempt to do this with silver didn't really turn out too well, and it could be that the whole Robinhood Reddit group may be taking a different look at this and deciding that maybe the easy money has already been had, and this is not going to be something that can be perpetuated.
There we go. Well, yeah, you're right. I think the regulatory side is where the big question mark is, right? Is that where the lasting ramification is going to be felt? Uncle Mike, really quickly, same question for you, sir. Are you believing we're living in a post-GameStop world, or is this a tempest in the teapot? And more importantly, what do you think our audience is voting for?
I think teapot, but what I hope happens from this, just to kind of add to what Sebastian was talking about on our Monday show, is that I'm hoping that they can get rid of T+3 in that for stock settlement. For what I do, for the most part, T+3 really doesn't affect me, but I really don't think we need to have that anymore. And so I'm hoping that changes. But in terms of this being something like what the crash of 87 was, how it created the skew in option pricing and things like that, I don't see that happening. But I think this is definitely one that we'll look back and smile upon when we say that the day that the millennials beat Wall Street.
Yeah.
There you go. Mr. Rock Lobster, final word with you, sir. What are you voting for? What's our audience voting for?
I don't think it will have really a lasting impact, but I think it will be. I don't think it will have a lasting impact on, and I think that's what the audience said, to be honest. But I could be totally wrong with this one.
Interesting. It started off very heavily, and yes, it's a post-GameStop world. As this has gone on for a couple of days, we've seen more votes coming in for no. It's getting closer to 50-50 now. It's about 56% for yes, we're in a post-GameStop world, and no, 44% tempest in a teapot. There you go. I said it that time. All right, you guys got about a day left over there at Options. Make your voice heard. A lot of you are making your voices heard. We've had a bunch of other polls Really quickly, our one we did that got the ire of Schwab and everyone else fired up when we asked, are the brokerage firms doing the right thing by banning opening transactions? You guys voted overwhelmingly on that one. No, it's my money, it's my rules, 75%. Only about 18% saying the brokers are doing the right thing to protect themselves, 6% saying yes to protect their customers, and other, including Schwab, at about 1%. And also, you guys saying the notion that we should price out of the money calls structurally higher going forward as a result of this, which was floated by a number of people out there. You said, no, this is a joke. 74% of you coming in on that. That one I think was a little bit more straightforward. All right, we got a bunch of things going on here. Let's go to my boy Luigi. Always a festive one. Always listening live out there. My boy Luigi says, good morning. Don't mean to beat the short squeeze to death. I listened to the boot camp show and to the other stuff related to it. Yeah, we've been doing a lot on GameStop of late, so check it out if you haven't, listeners. They all say that short sellers are needed in the market, but not sure I have heard why. Also, Longo keeps mentioning June 8th as the day everything bounced. That's my birthday. So, of course, that was a perfect day for a Uncle Mike Mini-Me Permabull. I guess Uncle Mike, he's a mini you. There we go. Well, you see, yes, obviously that's the reason that the markets are bouncing, because that's your birthday. Happy birthday. Belated there, Mr. Luigi. But yeah, the notion, we were talking about this with Dan yesterday. We were saying this a lot. About every decade or so, it seems like we have a moral panic around short selling. Something happens to precipitate this furor. A decade or so ago was the great financial crisis, the 08-07 meltdown, and we actually banned short selling very briefly here in the U.S. A decade or so before that, we had the dot-com meltdown. Everyone's like, oh my God, short sellers are horrible. You know, it seems to happen with a regular, so you can probably argue we're overdue for this kind of short-selling moral panic right now. But at the end of the day, you think about a world where you can only sell effectively to close from a stock position. You can't sell to open, which means you can't think a stock is going to go lower. What happens in that environment? Short sellers get a very bad rap out there, and a lot of them deserve it. They're jerks. They live by that, obnoxious sort. They try to talk these names down. Sometimes some of them do shady things to try to force the stock down. But at the end of the day, selling a stock that you believe is overvalued, and not just one that you own, is a important function of the marketplace. People forget short sellers were the first ones to sniff out Enron and a lot of these other scams, and they find these things first, and they beat the hell out of them. And that's kind of their function. They help regulate the market. When things get overdone, they bring them back in line. And that, it may not be a palatable thing to you. You may not like it. You may be a permabull like Uncle Mike, and sounds like you are here, Luigi. But that is an important function of the marketplace. If you take that out, look at any other economy that has done that. It's been a disaster. That by banning short selling, you're effectively saying we now have no confidence in our markets. And every economy around the world, whether it's in a currency, whether it's in whatever it is, whenever they take that step, the results are disastrous. This is an important function. It may be a distasteful one for you, but it is an important function for the market there. So that's why it's necessary. Things get overvalued. They need to come back in. And sometimes, as we've seen, the joyous effervescence of the market will not comply. So it needs to be brought back in line. Otherwise, the sell-offs that do come, and they do come, are going to be even worse and much more structurally damaging for a long time to come. So the short sellers do provide a function. They keep things in line. It's like the predators out there kind of culling the herd. No one likes it when the lion kills the baby gazelle, but it is a function at the end of the day of society and of markets and indeed of nature. We got to keep going. One more here. Another frequent listener, J3 Dingle. He's been writing in a lot. He says, isn't there a saying that 1987 wiped the smile off the options curve? Did GameStop put the smile back on? He goes on to write also, isn't Meatball living the past? Because Mark was talking about the problems with T+3 settlement. He says, isn't it T+2 now, I thought? Which you're right. Yes, most stock these days is settled at T+2. I think you got what he was talking about there. And he also says, have you ever run a poll question on which show has the best musical intro? I vote for Options Playbook Radio. Well, okay. Hey, maybe we'll do that. That's kind of fun. I probably would have to vote for this show's theme, the Option Block theme, because it has become kind of the default theme for the network as well. So I probably would vote for that one. My second place would be the newer kind of boot camp theme. I like that one. That's kind of a cool one as well. But Don, I wanted to read this one because you were the first one that I heard that saying from. That saying of 1987 wiped the smile off the options curve. What do you have to say here for our listener, Don, Mr. J3 Dingle? Do you think GameStop put it back on, at least in game, and if ever so briefly, sir?
Well, ever so briefly, yes, but surely not with the staying power of the SKU, which was born on the day that the smile was wiped off, mostly from the index side of it, October 19th, 1987. So prior to that time, you did have what was referred to as a smile, where basically if you plotted the implied volatilities of all of the options, including out-of-the-money puts and calls, they were fairly symmetrical. The ends turned upward, and you had out-of-the-money puts and calls at slightly higher volatilities than the at-the-money. And then came the crash, and people who had sold those out-of-the-money puts really got destroyed that day. And ever since, they've been priced much higher volatilities than their counterparts on the other side. So that persistence, which is 33 years and going strong, isn't going anywhere. Surely not in the indexes. But with individual names, you never really quite have that same phenomenon of the skew, not to the extent that it is in the indexes. And to that extent, yes, for a week or so, GameStop showed you that out-of-the-money calls can go a little bit berserk also.
All right, well, the skew may not be going anywhere, but we are into our final segment. It is time to go around the...
It's time to tell you what we'll be watching on our trading screens until the next episode. It's time for Around the Block.
All right, everybody. We're kind of coming up against it, so that music means we're going to do a combo of Around the Block as well as what it is people can look forward coming down the pike from you guys out there. And all right, let's start here with, let's go out to the folks there in the demand derivatives hot seat. Bob and Don, what are you keeping an eye on for from a realized vol perspective? And then also, if folks want to learn more about everything you guys have going on, you have the survey out there right now, you have the crowdfunding campaign. Maybe they just want to check out the realized vol indices. Where should they go? What should they do?
Yeah, so just go to demandderivatives.com, and on that main page, there are buttons for the volatility ranking pages. You don't even have to register. You just go there and click on it, and it pops right up. The volatility rankings are updated once a week on Fridays, actually Saturday morning. You go to the volatility ranking button, and it just pops up, and it gives you the 40 top assets in the world and where they rank as far as realized volatility goes. And right now, as I mentioned, the interest rate products, which I haven't heard anybody talking about it lately because they're so low. They're in the 1% percentile. So 1 and 2%. So they've basically never been lower. So, if you're looking for an interesting potential, buying opportunity in options, it might be in those short-term interest rate products. Anyhow, so you can click on there on the main page there to get the rankings. At the top, you can join our crowdfunding campaign and actually own part of our exchange. And it's only a $105 minimum. And if you do, we're thanking you with 6 months of free trading on our exchange when we launch. So that's a pretty good incentive for $105, I think. And also, if you go into the More section, take our survey. So it doesn't cost you anything if you just give us 5 or 10 minutes of your time. That would really help, because the more survey respondents, it shows, traction and some take up. And we really like to hear your thoughts, and maybe we'll, adjust things a little bit based on your comments. So if you really would like to see a competitor to the CME or ICE and like to help us out, just your thoughts would do that. So thank you so much, and please go to demandderivatives.com for that.
There you go. DemandDerivatives.com is the place to go. Click on the crowdfunding. It's still running. $105. Pick up a one lot. You listen to this show, you can pick up a one lot. That's less than one GameStop call these days. And you're going to get a piece of the exchange going forward. You also get all those trading discounts that Bob talked about. While you're there, maybe fill out the survey as well. It only takes a few minutes. Give them your thoughts. If you want to help shape the future of these markets, there you go. There's a chance to do it. DemandDerivatives.com is the place to go. And Mr. Uncle Mike, sir, what are you keeping an eye on for the rest of this week? And B, if folks want some help navigating these markets, where should they go? What should they do?
Well, not necessarily the rest of this week, but maybe the rest of this day might be able to make a new all-time high in the market. So watching that. Of course, we have non-farm tomorrow. And if anyone is interested in learning more about a financial advisor who is not afraid of implied volatility, stcharleswealth.com.
That should be on the website. He ain't afraid of no implied volatility. stcharleswealth.com is the place to go. And he might be a little scared of it, but he changed it into his alter ego, Volman. And then he's not afraid anymore. Mr. Rock Lobster, sir, what are you watching until tomorrow's vol views, at least? And then also, where should folks go to learn more?
You want to go to option? Oh, what am I watching? Okay, can we get below this 21 handle? Will people start selling options again? Will it all be safe? Will it all be safe again for selling options? That is the big question, because I think all the big earnings are out, right? All the big tech is out, and we continue to grind higher. So I think it just doesn't matter at this point. The market is basically self-fulfilling prophecy. But we'll see if vol can get lower and come on our option pit. Although Robinhood, we don't sell it anymore. That is now closed for a thing, I believe. So, but we got all kinds of other vol learning and trading legion, all kinds of stuff that you want to put your learning on. So come on over and learn how to trade.
There you go. OptionPit.com is the place to go. On behalf of the Rock Lobster and Bob and Don and Uncle Mike and indeed myself, I want to thank all of you out there for downloading, streaming, subscribing, for listening live, for sending in those questions. Keep them coming. And we'll see you back here in a little bit, 25 minutes, for TWIFO This Week in Futures Options. Let's talk about that silver squeeze that wasn't and a bunch of other fun stuff going on out there in a little bit. Back again tomorrow for Volatility Views, and it kicks off again next Monday with another episode of The Option Block.
This episode is sponsored by Demand Derivatives, a startup futures exchange and clearinghouse trading the world's major assets in a creative new way. You already trade on an exchange. Here is your chance to own one. Before they approach large strategic partners for funding, the pioneering team at Demand Derivatives launched a crowdfunding portal so that regular traders have the chance to buy shares. Learn more and become a part of this revolutionary fintech project now at demandderivatives.com/crowdfunding. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.